Welcome back. Well, the markets, as Sonia was pointing out, have clambered back into the green. So now they are at the point they started, 1/3% higher for the Sensex and the Nifty, and the mid-caps actually have taken it away, 0.6% higher, and that's giving, as we have been pointing out, a very positive hue to the advanced decline ratio. There are 8 stocks in the green, actually 9 in the green for 3 in the red. So that's 75% of the market better off than it was yesterday. The Bank Nifty is keeping pace with the Nifty for the moment, though Punjab National Bank is not one of the winners. Yesterday it rose by about 5%. Today it has lost half that gain. It's down 2.5% as realization creeps in that the bad loan picture is not as improved as it appeared. Some of the loans will go by another name. It will go by the name as refinanced loans. So barring those kinds of sell-offs, the markets in general looking better than they did yesterday. On that note, let's invite one person who actually reported a very strong set of numbers. Thermax is the company I'm talking about. We should pull up Thermax stock, and the 2% rise that you're seeing in that stock is clearly because of the number you just saw. That very strong rise that they reported in revenues, in EBITDA, in margins, in fact across the board. Let's invite Mr. S Unnikrishnan, Managing Director of Thermax. Good morning, Mr. Unnikrishnan. We always look at Thermax not just as a capital goods company but as representative of a sector as well. But I'll postpone the sector questions. You know, like I was saying, good on income, good on EBITDA, good on margins. Is this sustainable, or is it because of a one-off order that you spoke about, the Reliance order?
Certainly not because of one order.
Okay.
Of course, there are glimpses of that reflected in the results, but overall top line improvement and the bottom line improvement and the balance sheet improvement, which is very important for the company, has happened on account of the internal work related to the cost reduction exercises, waste reduction exercises, and certainly orders were available which were executable for the current quarter, which has helped the organization to have a rise in top line, which would also naturally mean the bottom line. But your question next is it sustainable going forward? Well, I opened the current year with lower carry forward orders to the extent of 1,000 crores. So it depends a lot more on how the economy is going to be panning out in the current year in terms of fresh order intake that will propel the balance sheet for the year end.
But you would have some idea of orders in the market already. Are you L1 in any place? What are the reasonable expectations of your order book refurbishing itself this year?
See, for the quarter one, we have registered a better order intake because the last year base was very low. I want to be honest, that's the way we had been always. We don't over project anything. Our order intake is far superior than the previous year's first quarter for the domestic market and the international market, but there is a base effect which has helped us. We are seeing a surge in order intake happening in the standard products, which is propelled by some of the sectors which are detached from the government policy making and not unduly worried about what's happening in the country. They are only worried about what is happening in Indians in terms of the consumption, which is the food industry, the food processing, the beverages, the pharma, the light engineering. These have possibly helped us to have a little better order intake. But a question related to the tendering, which is infrastructure related, I am afraid to say that improvements are visible but not on the ground to an extent where I can report that in the financial numbers in the current year or in the foreseeable future.
Okay. Mr. Unnikrishnan, morning. So can you just throw some numbers at us? I heard you mention 1,000 crores. Is that the order inflow in this quarter in Q1 itself? And what is the total order book now of the company?
Now, the order intake was for the company was 860 odd crores of rupees in comparison to 600 plus last year, which is an improvement over the previous year. It's 1,000 is the income, the revenues of the quarter. And order carry forward is approximately 4,250 crores at this point of time.
Okay.
Almost similar condition that what we opened the year in the month of April. So almost stagnant at that level, not increased, because the revenues have gone up in the current quarters, though the order intake is better, it is offset by the higher revenue in the current quarter.
Okay, Mr. Unnikrishnan, order is order, whether it comes from the food, beverage industry or light engineering, or whether it comes because of infrastructure. I'm only asking you, pro rata, can we expect this 1,000 crore run rate in revenue, this 91 crore run rate, 100 crore run rate in EBITDA? Can we go with that?
Certainly, if you have to take a run rate equivalent of 1,000 into 4, it will be lower than the previous year, Lata. It will not keep me happy or the market happy. So, whether we will be able to retain the last year's top line and an improvement in the profitability to a double digit towards the end of the year, well, we are working towards that. We'll be closer to what we were last year, and certainly we should be able to clock closer to a double digit profitability, which is an improvement that we've done in the EBITDA. Which should be practical because of the fact that orders on hand are executable, and I'm not seeing any slowdown in execution. That is equally important for capital goods companies, not only for me, for others, my colleagues in the industry also. Unless there's a cash flow happening, we will not be able to wake up the projects, which though, I mean, in my opinion, is happening despite all the worries about the banking sector, financing, bad debts, all that. I'm not seeing any retardation in the rate of execution of orders. Customers are wanting the projects to be completed. There is nothing like I'm a backseat driver where they say, sorry, you don't do it faster equally. That's not happening in the market right now.
What about the overseas market? Can you throw some more light on whether there is a demand, a consistent demand improvement that you're noticing in the overseas market?
Between the last year first quarter and the current year first quarter, without any larger projects, we had better order intake in the international market. Those have come from Southeast Asia and partly Africa and SAARC countries. There is an absolute no-no way of working currently happening in Middle East, which was a captive market for companies like Thermax. Hardly any major investment is announced or being taken up by the Middle Eastern market. Now going forward, Sonia, your question is related to, is it going to be repeatable for the next 3 quarters of the current year? If I were to look at the inquiry pipeline available on my sheet right now, it is better than the previous year for the Southeast Asian market, also for let me say the African market. But there are challenges in Chinese market where we have got our own subsidiary operating. Well, orders could be available, but the cash flow is an absolute difficulty in Chinese market. I mean, you can manufacture the equipment, but off-take of equipment is not happening. So there is going to be some retardation in that market that we are expecting. But Southeast Asia, Africa and the rest of the world, like Australia, little we do in the rest of the world, those should continue. And my take is in the current year we should have, at least for products of the company, a better order intake in the international market than what we done in the last year. But larger projects there also there are toughness because the European currency depreciation by almost 27 to 30% in the last 1 year, and Japanese currency depreciation is making it very difficult for Indian companies, not only for Thermax. Thermax like capital goods exporters, because when the customer is left with the choice of buying a European equipment, a German manufactured item at almost closer to Indian price, why would they want to go for Indian equipment? A brand is a constraint over there. Our means not Thermax, Indian brand. If their currencies were to appreciate, well, I mean, we should be able to perform far superior than we are doing currently.
Yeah, or if our currency were to depreciate, I take that point.
Yeah, well, I can't wish that as an Indian. Thermax,
No, you're not alone. The Reserve Bank very much wants the currency to depreciate, it just refuses to depreciate. No, but Mr. Unnikrishnan, final question to you, is there scope to improve margins, both operating as well as net margins, more scope in lower finance costs, lower commodity costs, lower any cost?
Thankfully, my finance cost is virtually nil. We don't have any borrowings, whether it is for conducting the business or a long term. So there, it is very limited chance available. If you skews internal system to such a level, only way to improve the margin is the top line going up, where you have got a gross margin impact because of fixed costs are covered. Otherwise, on our own to improve the margins are not so high anymore. Market is not very conducive. It's not a seller's market anymore, it's a buyer's market. And internally, our efficiencies are almost at the peak. Any further improvement can be detrimental for, I mean, I would say, our main asset is not manufacturing. I mean, I would say human beings and human intellect. That we cannot compress beyond a level by curtailing expenses beyond a level. I will not recommend it.
All right, Mr. Unnikrishnan, we leave it at that. All the best for the quarters to come, and we hope the situation both domestically and export continues to improve. Well, that's the word coming in from Thermax. Good numbers this time around, and the stock is up 1.5%. But let's move on. Skipper Limited is the stock on our radar.